Everybody, it's Garrett Nell with Bring Home Denver, your local real estate experts. Today we are sitting down with Troy Vigil with EA Buck Tax and Accounting Services, and we're just gonna have a quick conversation. So, Troy, thanks for sitting down with me today. I really appreciate it.
Thanks for having me. Glad to help.
Yeah, absolutely. And Troy, just so you know, has been our bookkeeping, accountant, tax advisor for almost 10 years now. We've sent numerous clients over to him. He has been just a wealth of information and help as we've navigated multiple properties, building a business, and growing some wealth. So he has agreed to speak with any of our clients and be a resource to us when you're buying or selling and as you move through this tax season.
Yep.
So Troy, I just wanted to talk to you a little bit about, I know a lot of folks are out there thinking about selling their homes and they're concerned about capital gains. They're concerned about what the tax implications are. Can you talk that through a little bit with us?
Yeah, you bet. So one of the most advantageous tax rules in the code is excluding the gain on a primary residence if you meet certain criteria. If you're single, up to $250,000, and if you're married, up to $500,000. And really, it comes down to it's got to be your primary residence for at least 2 out of the last 5 years. There are definitely some wrenches that can be thrown in that, like if it's been a rental property or if it was inherited, or there's a lot of other things that impact it. But the key takeaway for our audience today should be that if you're single and you've lived in your house for at least 2 years, there's a good chance that you won't pay tax on the first $250,000 of the gain. And if you're married, you wouldn't pay tax on the first $500,000 of the gain. And like you said, in this market and in this region of the country, we've had so many clients take advantage. It's called Section 121 exclusion because you're excluding the capital gain. We've had so many clients take advantage of that the last few years, you know, thinking that they were going to owe tax on that appreciation or that gain that they're pocketing, when in reality, the government doesn't tax you on that if it's your primary residence.
Absolutely. That's great, because I know a lot of people are looking to capture all this equity that they've built up over the last couple of years in their home and put that into the next home. And the common question I hear from people is, do I need to do a 1031 tax exchange to access that money? And they don't, correct?
Correct. And I get that question here a lot too. And just for our audience to know the difference, a 1031 exchange is when you're selling or trading business property, so rental property that you're collecting rent on. That's when you would utilize a 1031 exchange if you didn't want to pay the taxes on it. Section 121 exclusion, what I was talking about, is for a primary residence, and you don't have to replace the property. You can sell it and take the proceeds and go to Las Vegas if you wanted to, but
awesome.
Which some people probably do.
Maybe not the wisest, but yeah, it's up to you.
Right. So if you do have questions, feel free to email or call, and we'll help you as best we can to make sure you understand what you're doing.
This is why we love working with Troy. He's great. Thanks everybody.
Thanks, Garrett.